How to read a 10K financial report. Learning to read a 10K annual report is so important to get to know the overall state of a company. But it can be quite overwhelming and sometimes boring to read this annual financial report if you are new to investing and business. In this video, we're going to teach you how to read a 10K financial report efficiently without being overwhelmed. But before you learn about how to read a 10K financial report, pay attention to the big red subscription button. As soon as you click it, you will be taken to the wealthy side, the life you deserve, where you'll find hundreds of videos. These videos contain the answers to almost any question you may have. There are also daily updates, so if you want to stay tuned, remember to turn on notifications. In the investment world, American regulatory authorities ask listed companies to publish 2 reports once a year. Public traded companies are required to file annual and 10K forms to SEC, the U.S. Securities and Exchange Commission. The annual report is a short, glossy document with a letter by the CEO, whereas 10K is a more extensive black and white document. 10K report is mandatory for all public traded companies. It is the most significant corporate report for investors and shareholders. Government forces the business owners to give information about their business and make the information completely transparent for the investors, shareholders, and the public. We'll discuss what's in a 10K report shortly. So, if you are an entrepreneur or new to investing, keep watching the video to find out how you can read a 10K report without getting bored. Where can we find the 10K report? If you Google 10K with the company's name, you can find it either on the company's website or on the Edgar database of SEC. It is publicly available and anyone can access it anytime. Let's discuss the items in the annual report on Form 10K. Okay, so once you find the 10K form, you'll see that there's a table of contents. It has several sections, but we are mainly going to focus on the first 2 sections. The first section is about business and related risk factors, its products, operating strategy, and stuff. And in the second section, the overall performance of a company and numbers are analyzed. We will discuss how to read those financial statements and which numbers are most important while analyzing a report. Typically, it is 100 pages long, but no one has the time to read the whole report. We're going to help you read the report efficiently and focus on the things that are important for a new investor or analyst. Section 1. For new investors, Section 1 holds importance because it covers the history of a business, its products, and its services. Moreover, it gives a detailed list of risk factors and legal proceedings, which helps new investors decide if they are interested in a business. So, you must be thinking, isn't the financial part the most important one? Why are we wasting time here? My answer to this is no. This section is important because if you don't like what the business does, its products, risks, and place in the market, there's no point in investing in it, right? Number 1. Business section. It primarily outlines the goals, history, and products of a company. Moreover, it highlights where the company stands in the market and its marketing strategy. Understanding how the company operates will help you understand the context of the rest of the form. Knowing what it offers and how it evolved over the years is important for interpreting the trends in the financial section. Right after the business section, you'll see the number 2, risk factors. It describes various risks a company might be facing that investors should know about. Although not everything can be predicted, knowing the potential risks can be quite useful for new investors and shareholders to make an informed decision. What you need to know is that companies list their risk factors as they are and don't provide any information on how they are dealing with them. However, any new risk which was not present in the past presents a red flag and should be analyzed. So, it is advised to dig into the risk factors before making a decision, especially if you are a new investor. The last thing important in Section 1 is the number 3, legal proceedings. It outlines the legal issues a company is currently going through or has dealt with in the past. No one wants to invest in a business involved in a lawsuit or other legal proceedings, so going through this section can be helpful. Section 2. You'll see a few headings, but first we will be looking at Management Discussion and Analysis, or MD&A. Management and some executives analyze a company's performance over 12 months, both qualitatively and quantitatively. They comment on the overall performance and give their perspective, or rather, tell a complete story of what happened in the past year and how it shaped the business. Many factors and aspects are evaluated to predict the company's current state. This type of information is crucial for investors, shareholders, and analysts. Management comments about financial statements, market risks, controls and procedures, and future goals and aspirations. They also interpret the way numbers in the financial statement are affecting the operational strategy of the company. Having said that, an investor needs to know that MD&A is not audited like other sections. It is only the opinion of management regarding the company's performance and future predictions. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload such informative and educational videos. Let's continue. The other important item of Section 2 is financial statements and supplementary data. We know you are here for this information, so let's dive into it without further ado. Shareholders and potential investors must know the economic health of a business. Financial statements are extremely valuable for interpreting the earnings in the past year. Given that, the economic status of a company is predicted by comparing it with other firms, industries, or sectors' financial statements. The financial performance tells how well a company generates revenue and manages cash flow. 3 audited statements are included: the balance sheet, income statement, and cash flow statement. It's a bit tricky to read if you are new to the investment world, but with thorough guidance and practice, you can easily interpret the information. Balance sheet. A balance sheet gives you a complete picture of the current finances of a company. It includes the details regarding the company's assets, liabilities, and equity ownership in the past year. It tells you how skillfully a company controls its assets and liabilities. So, to look at it closely, let's break the components of a balance sheet one by one. Assets are anything valuable a business owns, be it furniture, cash, buildings, or patents. It adds value to the business. Next, we have liabilities. In easy words, liabilities are debts you owe to other people or companies, like bank loans, mortgages, taxes, wages owed to employees, etc. Equity is the value of the company that remains after deducting liabilities from assets. So, the balance sheet equation is something like this. Assets are equal to liabilities plus equity. So, the value of assets is determined by adding liabilities and equity, and that's how you know the company has made a correct balance sheet, if the assets are exactly equal to liabilities and equity values combined. The balance sheet tells the investor if the company will be able to pay debts within the next 12 months. It is essential to assess whether the balance sheet improved over time. It's a great indicator of a successful business. In the balance statement, a couple of ratios are calculated, which tells us the financial situation based on this particular statement. The current ratio measures the company's ability to pay debts within a year. It is calculated as current assets over current liabilities. A good liquidity ratio falls between 1.2 and 2 and tells that company has double the assets than liabilities, and debts can be paid within a year. However, a ratio below 1 indicates that the present assets will not be enough to pay the debts. And debt-to-equity ratio, or D over E, measures the total debt relative to the amount originally invested and how much is earned over time. It is calculated by total liabilities over equity. It is important to look for a low debt-to-equity ratio, ideally below 1, but less than 2 is also considered fine. It tells that a company is profitable as a lower ratio shows fewer liabilities than assets. A ratio of more than 2 might be problematic for a company's growth. Income statement. The income statement is also called the profit and loss statement. It tells the operational performance of a company in a given year. This means that you get to know how much a company has spent and earned in the fiscal year. In easy words, it tells you how much profit is made in a year. This statement lets you calculate the net profit. It starts with sales and revenue and ends with gross profit. Let's have a brief look at the components of the income statement. Revenue or sales shows how much money a company earns from the sales or services. Direct operating costs, or costs of goods sold, or COGS, is the total money spent on labor and material to make a product or service. And the gross profit is the amount left after subtracting production cost, or COGS, from the total revenue generated. Indirect operating costs include all the costs of running a business, like rent, utilities, operating staff, etc. In easy words, money is spent on things other than making or distributing products. Operating income is gross profit by deducting the direct and indirect operating costs from revenue. Finally, tax is subtracted from operating income to get net income. This tells you how efficiently a business is running. We also get the idea of how different activities are affecting the company financially. However, some values give you a better idea. In the income statement, gross profit shows how efficiently a company earns a profit while managing the production and labor costs. A good gross profit usually differs among businesses, as every industry has different operating costs. So, it is important to analyze related industries' gross profit margins to see if your company is growing and competitive enough to stay in the market. It is usually in percentage. On the other hand, net profit tells how a company is earning after subtracting all expenses. It essentially indicates how well the management is taking care of expenses and the overall business model. Although it also varies with industry, generally a 20% margin is considered good, whereas less than 5% is pretty low according to analysts. Cash flow statement. A cash flow statement depicts the cash that entered and left a company during an accounting period. It gives a detailed picture of cash inflow and outflow based on various activities. Activities mentioned in the cash flow statement are operating, investing, and financing activities. Operating activity includes both revenue and expenses. It is the cash that remains after the delivery of a product or service. Cash flow from purchasing and selling assets like property, equipment, patents, etc., or investing in other businesses comes under investing activities. Whereas cash from financing activity includes cash from debt, stock repurchases, and paying dividends. Steady and consistent cash flow depicts a healthy economic situation, whereas huge fluctuations in cash flow indicate a red flag. The most important number to follow in a statement of cash flow is operating cash flow, or OCF. It is important as it indicates cash generated by basic company operations. A good value greater than 1 interprets that a company can maintain a positive cash flow to maintain its operations. Many analysts and investors believe that a value of less than 1 means that a company requires more capital to thrive in the market. These are the few performance indicators of a business based on a 10K report that many investors and shareholders believe are the most important. You can read through these to get an idea of how well a company is doing without going through the full report. Did you enjoy the video? Please hit the subscribe button, like, share, and comment.